This is the current federal tax developments for the week of August the 17th, 2026. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers from Phoenix, and we're going to talk this week about a whole bunch of activity that's taken place. It's been a lot happening in a short time. Also, you'll notice I'm back to the old style layout for the most part here. Been working, as I think I've mentioned a couple of times before, I've been working with Notebook LM. We'd had Notebook LM deal with the slides, but I've now basically been able to finagle getting Claude to handle helping me set up these slides, which can save a bunch of time, especially with this many things going on. It's useful. So, a couple of things you'll notice this week. First, you may want to download the slides because they will have the illustrations again this week. I'm going to start putting those to the front of the group as kind of your highlights for the section. And we'll also have just kind of the standard slides forms like we've had before. Like we said, there's a lot went on this week. So we're going to go over it, take a look at it, try to work up what's going on. And we got a bunch of slides to get through, I think 72 actually. So we're going to get moving here. So we're going to talk about this week. We're going to talk about some technical guidance under Notice 2026-48 regarding the Savers match that was part of the Secure Act. We're going to go through some reporting thresholds for 3406 backup withholding and the de minimis section 6050W reporting thresholds for things like 1099K. We finalized those regs. I'm going to talk about a couple of equitable tolling cases. First, the first equitable tolling case, one the Supreme Court decided and has now been sending us back to tax court for lots of things recently. This is going to be the actual, apparently final chance in the Boechler case. We'll discuss how Boechler won her case at the Supreme Court, but unfortunately, actual equitable tolling has now been denied by the tax court and now the Eighth Circuit. So unless she can get the Supremes to hear this, or she can get the Eighth Circuit to reconsider decisions, and we'll talk about reconsidering decisions this week too, or going bonk, this should be the end of the line. So Boechler will be kind of like years ago what we had with, the case of John Cheek, who won at the Supreme Court in a, attempt to criminal tax case actually against him by arguing that whether or not he had the question was whether he had a good faith belief that the tax position he was taking was legit rather than whether a reasonable person would have. Which, you kind of think about that, you go, well, okay, I'm arguing I'm an idiot. But the Supreme Court said you're allowed to do that. The problem is nobody would believe John was an idiot. That's what happened at trial. This is somewhat the same thing in the case of Boechler. She argued that there should be equitable tolling, but unfortunately, because one negative for Boechler, because the case is Boechler PC, we're going to discover that Ms. Boechler is an attorney. And missing filing deadlines is a little tougher for an attorney to justify as to why that's reasonable. So yeah, it turns out that it didn't. She won on the theoretical side and lost now on the practical side, absent of getting the Supreme Court to hear this again or getting the Eighth Circuit to reconsider. Neither of which is probably terribly likely at this point. So there's a decent chance we're at the end of the road for that one. Now, talk about proposed regulations for contributions by employers to Trump account and some additions to the non-discrimination rules, not just for Trump accounts, but for essentially employer-provided education benefits, because those have never really been filled in. And since the Trump account borrows the same rules, it'd be kind of nice to know what the rules are, because even though they don't have the rule here relating to contributions made to, basically somebody who is related to or is a controlled employee, or who is a shareholder, entity equity holder, they do still have to meet the discrimination rules. So kind of be nice to know what those are. We're going to talk about carryover substantiation. This is the case of Beacom. And in that case, we're going to talk about the fact of why you should never tell your clients that it's a hard and fast rule they should keep their tax records for 4 years. We're going to discover Mr. Beacom did that, and Mr. Beacom lost his AMT credit because he did that. So we'll talk a little bit about that, why the 4-year rule is misleading. There's a reason why we say 4 years or 5 years, but you have to understand the nuance of what the 4 years or 5 year rule really means, as opposed to just making blanket statements. Any records that are more than 5 years old, you can junk. We have our second equitable tolling case, and this person, case of Maniktala, sorry, butchered that name. But in this case, that taxpayer needs to thank Boechler, because for a practical purpose, the Boechler case is part of the reason why this taxpayer is going to be allowed to argue. For equitable tolling, the tax court has agreed that in the particular area that this taxpayer is looking at, equitable tolling should be allowed. We also have the attempt under Secure 2.0. The IRS was charged with putting out guidance to allow simplified methods of transferring balances from employee retirement plans to IRA accounts. That came out this week in Notice 2026-49. They're not really mandatory at this point, but it's open to discussion of what the IRS is saying. We're probably going to see this required. So if you work with employer plans, understand that this is voluntary right now, but there's a really good chance it'll become mandatory at some point in the future. We're also going to have a brief discussion of some Section 987 relief for controlled foreign corporations and proposed regs. That's not an area I specialize in by any means. But if you do, we're just going to let you know enough so that you know to go look there. We have a very surprising change of direction by the Fifth Circuit. This case, the Fifth Circuit, in the case that formerly was Serious Solutions and is now K. Elaine LLLP. Remember that case where they decided that, you got the special 1402A13 exception from considering your income, business income flowing out to you from a partnership to be self-employment income if you were a state law limited partner? Yeah, about that. The majority in the case granted the request for a rehearing. The Fifth Circuit denied an en banc hearing, but then they totally rewrote their rationale. So that whole bit about limited partner, all you need to do is look at your state law limited partner. If that's what you got, which most people did from the case we have under Serious, that is no longer the holding of any Circuit Court of Appeal at this point. We'll talk about that. It's a really weird decision. And by the way, the dissenter still dissents. But the dissenting judge did point out that, these guys went up and cleaned up a lot of things that I said was wrong, but I still think it's wrong because I think now they've just invented a test after whining that the IRS's test was going to be very difficult to apply and wasn't really spelled out in the law. They've now gone and created a test that is very difficult to apply and is not outlined in law. That's summary the dissent. We'll get back to that. And then we're going to talk about a win by a taxpayer in a conservation easement case that went to Court of Appeals. This is the question about whether the tax court needs to actually make a decision on the highest and best use of an asset in a conservation easement valuation. Now, this is another one of those cases where it doesn't mean that Evans is going to win. It means, though, they've got to go back and the tax court has to actually do additional work in order to make their decision. So, interesting case. And yeah, that's all of them. We've got a ton of stuff this week. And I see we're nearly 9 minutes in and we just got through the list of what we're going to talk about. So let's start talking about things. The first we're going to talk about is Notice 2026-48 issued on August the 7th. And this is going to be kind of dealing with the Savers match. And it's going to be technical guidance and operational frameworks under that notice. Fundamentally, the Savers match, you may remember, is something we've had and that Secure 2.0 Act changed dramatically, right? Essentially, the Treasury has a match of up to 50% of retirement contributions, and it will replace the old Savers credit beginning in 2027 next year. This will be it will shift from being a non-refundable tax credit to a direct government contribution to retirement accounts, with a chance to get the money back only if it's a very, very small credit. You meet the de minimis rules, right? And this particular illustration you see on the screen, if you're looking at, the materials, looking at this on the video run, or if you've downloaded the slides, which again are going to be available on the website, currentfederaltaxdevelopments.com, that talks about the eligible individuals, eligible and ineligible individuals, right? And also the savings vehicles into which this match can go, which will include traditional IRAs, 401ks, 403bs, and 457b plans, right? And as well, the income phase-out limits, because like many things in the tax law, Congress gives but decides if you make too much money, we're not really giving. These phase-out limits are honestly relatively on the modest income side, right? Your clients, probably most of us are not going to deal with many clients that meet these tests, except potentially, kid in the year they graduate or something might make these in. So we'll talk a little bit about that. But let's take a look at this rule, right? Secure Act 2.0, not the original one, the 2.0 version, in Section 103 added Section 6433 of the Internal Revenue Code. And it's going to take over from the old Savers Credit. This is our last year for that one for most things. And it substitute a federal match of up to $1,000 per eligible individual beginning next year. Right? It will be paid directly by the Treasury into an applicable retirement savings vehicle. I've mentioned those already, right? Unlike that old credit, the match is available even if the individual has zero tax liability. Previously, that credit did you very little good unless you had tax liability. But because the cutoff ranges were so low, in many cases, the tax liability was close to zero anyway. So the saver's credit wasn't worth a lot in most cases. It was worth very little. Now, Executive Order 14403 did direct Treasury to launch a TrumpIRA.gov portal by January 1st of next year. And it will list registered low-cost IRA providers that people can use to direct these funds into or open an account on their own. So that's supposedly coming as well. Keep your eye on that one. Now, some things this notice tells us. An eligible individual must have obtained age 18 by the close of a taxable year to be eligible for this match. Excluded are students under Section 152F2, those that can be claimed as a dependent on mom and dad's returns, any individual otherwise claimed as a dependent, and non-resident aliens or individuals claimed as a dependent. Remember, the students, even if they're not claimed, are going to qualify, are going to be blocked. Other people, apparently, if they're not claimed, are going to be able to do this. That's not totally clear. We'll get a little more guidance later. And non-resident aliens that absent making the election under 6013 G or H. Now, a Department of Justice Office of Legal Counsel opinion treats the match as a PRWORA federal public benefit. So future regulations may bar some non-citizens from being able to obtain this. Now, qualified contributions that I mentioned include IRA contributions under 219E, 402G3 elective deferrals, which are included in things like 401k plans, right, and 403Bs, governmental 457 deferrals, and the after-tax plan contributions. Now, IRA contributions made by the extended due date, including Form 8888 refund allocations, remember you can allocate your refund to go to the IRA, may be designated for the prior year and go into this calculation. And contributions are reduced by distributions in a testing period covering the current year, 2 prior years, and the period up to the extended due date of the return. That is, we're not going to let you put money in, get a match, and then yank money out. That's going to be a problem. If you're yanking it out, we're not going to let it go there. The idea is we want this saved for retirement. So there's a nice long period. The money's got to be in the account. Can't be pulled out. Now, this unreduced match equals 50% of the first 2,000 qualified contributions. That's where we get our $1,000 maximum under the program. Now, modified adjusted gross income calculation here adds back the standard 3 things, right? The foreign earned income exclusion, the foreign, basically the foreign housing exclusion, and the territorial income exclusion, and any deduction or exclusion of qualified retirement savings contributions. So your 401k contribution has to be added back when computing your modified AGI. We reduce by 50% times the modified adjusted gross income minus the applicable dollar amount divided by the phase-out range, rounded down to the next whole point. That's percentage point, right? So for 2027 parameters, we start at phasing out at $41,000 for married filing joint couple with a $30,000 range, so all gone by 71. Head of household, we start phasing out at $31,750 and phase over $22,500. So essentially, we're going to be done with this by $53,250. We're totally gone. And if you're single or married filing separate, we start phasing out at $20,500, totally gone by $15,000. So everything's gone at $35,500. Now, these dollar amounts will be indexed after 2027, but the width of each phase out range remains fixed. This happens a few times. So when we start phasing out goes up, but we don't expand the range. I understand if you're truly inflation adjusting, you should expand the range, but we don't. Look, Congress can only deal with one multiplication at a time. Their minds are blown if we try two. So we don't do that. Okay, that's a little snarky, I guess, to say. What I will say is obviously it would cost more money if that was indexed as well. And that basically plays into why they don't do it. So an example, a single filer with 30,000 of modified just gross income contributing 1,500 traditional IRA a day will get a 19% percentage or a $285 match into the account under this program. Now, the match is claimed on a new Form 8880A, -A actually. A match under $100 may be elected as a refundable tax credit. But once we get to $100, it's got to go into a retirement fund. Traditional IRAs require an IRS-issued IRA tracking number from registered provider that you have to obtain before the return is filed. So the idea of this is you will reach out to, let's say, your custodian. Let's say your custodian is Fidelity. Fidelity will give you an IRA tracking number. You will provide that on the return, and the IRS will use that tracking number to essentially send the amount to Fidelity, and that unique tracking number will label Fidelity to understand which account to put it to without having to actually put the account number into the return. Be nice they consider that for certain other things, but of course, that's one problem at a time, please. Roth IRA destinations run through a Treasury conduit IRA and a trustee-to-trustee transfer. That'll be a taxable Roth conversion subject to 3405 withholding. So if you take it and put it in a Roth, you're going to pay tax on it. I don't know how many times that's going to happen, but that's it. For employer plans, there are three proposed pathways. Could be a provider registration, could be an automatic match using auto portability data, or a confirmation number rollover. Now, the match is treated as an elective deferral for rollovers under Section 411, subsection A11 of the Code, Section 72, subsection P, loan and survivor annuity purposes, right? And this match is ignored for Section 402, subsection G, the basically deferral limits. 415, subsection C, the total amounts going in the account, and 457B2, right? And also for ADP and top-heavy testing. Hardship distributions of the match are barred. You cannot take a hardship distribution of the match. Again, it's going in there. It's supposed to be for retirement. It wouldn't be there, right, if this program wasn't in place, so it's going to stay put. You get the feeling they're trying to put enough guardrails on this so people don't just throw it in there and find a way to grab it right back out of the plan. Now, erroneous match contributions are treated as underpayment of tax for your determination, but accuracy and fraud penalties will not apply to those. That's interesting. Distributing the erroneous amount by the extended due date makes it non-taxable and exempt from the Section 72 subsections T tax for premature distributions. Any attributable earnings will be taxable during the period it was in the account. A saver's match recovery tax applies when early distributions leave the aggregate match contributions exceeding the year-end account balance. That'll be a kind of clawback. The recovery tax is reduced by any Section 72 subsection T premature distribution tax paid and any allocable investment losses. Now, taxpayers can cure it with trustee-to-trustee contribution in 60 days of the distribution up to the return due date. Right? And participation is voluntary. Adopting plans will need to make an amendment by plan year. It's not required, it's discretionary. And prospective termination does not involve Section 411D6 of pulling some benefit away from the employee. Okay, so again, this is our notice pending when they actually get to regs. But since this program starts next year, it's kind of important we have some guidance on the way. Next up, we're going to have final regulations establishing the backup withholding on third-party network transactions and de minimis reporting thresholds. This is Treasury decision 10,053. It's published August 10th, 2026. And this is the very circuitous route we've gone through to get back to what we originally had, right? Basically, there was a $20,000 and 200 transaction rules we started with. We again had a change of the law a couple of years back that would have made those much lower, right? And so we're going to go back to pre-ARPA. ARPA lowered these standards. It was a way to raise money. Everybody's whined about it. IRS has given administrative relief every year it was supposed to apply. And last year we got rid of it under One Big Beautiful Bill Act, right? Now, there is catch-up withholding is kind of interesting here, right? It's got a catch-up withholding requirement. We'll talk about that. Withholding begins on the specific transaction that pushes a payee over basically the thresholds. So you got to be there, right? That's it. We have a special rule, though, if they went over in the preceding year, then you've got to start withholding from $1. And also, it's got an Apple tax rate change. So we'll talk about all of that. That's just in our illustration. Okay, so what does Treasury Decision 10,053 do? Well, bottom line, if you remember our discussion, the proposed regs were issued on January 9th. It basically adopts those without any really major substantive change. Now, Section 6050 Cap W, which was enacted in 2008, originally required a 1099-K reporting only above $20,000 of payout and 200 individual transactions. In Section 9674 of the American Rescue Plan Act, cut that threshold for third-party payers, to a flat $600 and eliminated the transaction account entirely. Much yelling and screaming ensued, and so notices 2023-10, 2023-74, and 2024-85 delayed the rules and are obsoleted as of January 6, 2026, when the proposed regs came out. And the One Big Beautiful Bill Act, Section 7432, subsection A, retroactively restores this $20,000 200 transaction threshold as if it had been included in ARPA to begin with, or if ARPA hadn't really done anything. Now, again, I'm referring to this as the One Big Beautiful Bill Act because I'm not, the first thing is these regs didn't get the memo about the working families tax cut name. Secondly, as I've said, Ways and Means is not really consistent in their releases these days about which term they're using. So even though the Treasury seems to be drifting more that way, to keep us from losing our minds and thinking there are two tax bills out, there was only one, I'm going to keep calling it the One Big Beautiful Bill Act. My rule for all future administrations, all future Congresses, once you name it, I'm keeping the name, even if it gets struck, as part of the reconciliation package. Because, I just don't know. I mean, obviously, the belief is the name doesn't poll well. So now we got a different polling for it. Okay, different word. Okay, now section 3406, subsection B3F of the code makes 6050W transactions reportable payments subject to a backup withholding whenever a payee fails to furnish their taxpayer identification number. Under that section, 3406, subsection B4, reportable status was determined without regard to any minimum reporting amount. Withholding applied from the first dollar. OBRA added 3406, subsection B8, effective for taxable calendar years after 2024. So retroactive. Backup withholding only applies once the payee exceeds both 200 transactions and $20,000 in gross payments. And 3406, subsection B8B, look-back exception, will deny that de minimis relief if any payment to that payee in the preceding year was reportable. So mechanically, let's say you start, a new person shows up, you pay them, and you end up paying them $25,000 on 250 transactions. Well, beginning with the transactions where they've got 250, they've got more than 200, and they've gone over 20,000, you're going to be forced to withhold. Don't worry about the ones that were below that level. However, next year in 27, that person gets $10. There's going to be withholding if you don't have valid TIN, right? That's going to be the key. If any payment to that payee in the preceding year was reportable, we're just going to assume we're going to. So basically, it allows you as long as you stay below the limit. But if you go above the limit, then you're going to stay there. And the way I read the rule, once you've gone above, you're just above forever. Because every year you're going to have, unless you skipped a year and had no payments at all. That's the only way to get, to me, it seems like, to get out of 3406 subsection B8B look back. Maybe wrong, maybe over broadly reading that, but it seems likely that's going to be your problem. Now, proposed regs, and I should say final reg now, 3406A dash 1 subsection A drops the outdated hard-coded 31% rate for backup withholding in favor of the fourth lowest rate under section 1C, right? And again, regulation section 3406A-1 subsection C adds a cross-reference to new de minimis exception and corrects a cross-reference typo that was in the old regs. The prior without regard to clause in regulation 3406 B3/5 subsection B is removed entirely from the regulations. And the new regulation 3406 B3/5 subsection B2, withholding attaches to the entire amount of the transaction that crosses the latter of the two thresholds, plus all later payments. So you don't get an out, right? Let's say that we have 200 transactions and they add up to $5,000. But now we get, or say 199 and 200. So we've got the 200, but we don't yet have the 20,000. Now we get a $50,000 transaction. Withholding is going to apply that transaction, even though we weren't above before that transaction. The transaction that takes you over the second limit is subject to withholding, right? And the look back rule is codified or put into the regs at regulation 31.3406B3-5 subsection B3, which goes ahead and puts that prior year look back payment means withholdings from $1. There are 4 examples in this regulation. 2026, no withholding on the first 200 payments, but the 201st payment crossing $20,000.01 is withheld in full, as are other payments. 2027, only 199 payments, total 18,000. Yet every payment is withheld because the 2026 payments were. Right, we get there. 2028, 4 payments totaling 4,000 remains fully withheld. The look back chain propagates year over year. Then, like I said, 2029 we get nothing. Because we had a year with no payments, the chain is broken, and we now can use de minimis. So once you're in, even one transaction a year is going to keep you in, right? All withholding is going to be required unless you get that TIN to them, right? All 8 comments received in the regs were rejected. The rules apply retrospectively to payments in calendar years beginning after 2024. And remember, you are told the fact it's not on a 1099K or the fact it is on a 1099K does not determine if the payment is taxable. The threshold is not a safe harbor, and it's not a safe harbor for account splitting. That is frowned upon, right? Trying to split yourself over enough places to be able to stay below the magic numbers. Yeah, that's kind of a problem. Okay, let's go to the end of the story for our attorney in Boechler, BC. This is equitable tolling and tax practice. The Eighth Circuit gave what is likely the final ruling in the saga of Ms. Boechler, right? This is Boechler PC versus Commissioner, case number 252620. This was issued by the Eighth Circuit Court of Appeal on appeal from the tax court, and the decision was issued on August the 10th, right? Equitable tolling. These are the key lessons we have from Boechler. 2-part test for equitable tolling. First thing is you must show, if you're trying to claim this, you screwed up, you didn't get your tax court petition in, and this is on a collection due process case, is where Boechler covered. You don't get it in within the time frame to file for the case. That's listed in the code. You've got to prove you took all reasonable steps to ensure your petition was timely. And you also have to show there were extraordinary circumstances. Extraordinary. That means delay must be caused by factors that are truly beyond the litigants, the person trying to get in courts, control. Now, think about this for a second. You can see where being a member of the bar might prove a problem to get the judge to believe that you're going to meet this test, right? Somebody who truly, doesn't really generally work with the courts, isn't used to these things, way easier in theory for them to meet this. Not easy. Please don't think I said easy. I said easier. But an attorney's going to have trouble. But the good news is attorneys are the very type of people who will litigate this Supreme Court, which, in this case, Boechler did. She said she accidentally miscalculated the date, the 90th day. Yeah, attorney's not going to get away with that. That's going to be simple. Also, her workload and family issues weren't extraordinary. Workload, she was managing a whole bunch of cases. And here's the problem. Remember, her name's Boechler. The firm is Boechler PC. Who do you think the firm's named after? 100% shareholder. The court's bottom line is your workload is your decision. You took on all this work, and you haven't blown the cases for them, which also comes back to haunt you. So it seems like you could have got this done if you were paying attention, right? And, and the family issues, they were sympathetic because of issues with her mother, but they also said there were other family members that were working with to take care of this. They just didn't see that it rose to the level that would have totally blocked her from doing this. And there was no evidence that she had been diligent, right? She didn't show any evidence to verify the deadline with counsel or staff. Didn't seem like she was diligent in trying to make sure she met her requirements. That's going to be her problems here. Again, going to be difficult for an attorney to make this work. Just going to say, good news is we needed an attorney to take the Supreme Court because most other people would take a look at at all the mess of trying to litigate it and would give up. Attorneys are known to fight, especially if they're litigators. The bad news is, though, realistically, she is the worst fact pattern. Being an attorney is virtually the worst fact pattern in this case. And unfortunately, the court kind of points that out. So in this case, the IRS had assessed information return penalties under 6721 against Boechler PC for 2012 and issued a final levy notice on October 31st of 2016. Halloween, great Halloween gift. Appeals issued a notice of termination dated July 28, 2017, sustaining the levy and starting the 30-day clock for her to file a petition under 6330 D1 to basically bring the tax court into this. That 30th day fell on a Sunday, so Section 7503 of the code pushed the deadline to Monday, August 28th. Unfortunately, her petition was mailed on the 29th. Not only did she get wrong adding 30 days, but the catch was, she could have been a day off on adding 30 days and she'd have gotten to Monday, which would have still worked for her. But she got to Tuesday. I mean, literally one day late, right? That sole attorney had miscalculated the due date. And, the court's kind of like, really, Ms. Boechler, you should have recognized this. You're an attorney. You deal with these dates. You deal with deadlines for doing things. This is something that you, of anybody, should have confirmed. Now, the Supreme Court held in 2022 that the Section 6330, subsection D1 deadline in these cases for filing your request to go to tax court is non-jurisdictional and is presumptively subject to equitable tolling. Now, the Supreme Court almost never finds facts. It declined to grant tolling. It says, we don't go rehear facts. Trial court, you need to go hear the facts now, get presentations of the facts, and then make a decision if equitable tolling applies based on our rules. This is often going to happen. This is why we see cases like Cheek bounce back, right? They go to the trial court, and then you don't end up with real relief. This is one of the problems. The tax court held a trial on June 10th of last year with the firm's sole attorney as the only witness, right? She described a solo practice, 25 active asbestos cases, that was her thing, and 60-hour weeks during the filing window. And of course, a lot of us in tax practices like, well, that doesn't sound like a lot of work. All of that issue. But nevertheless, she's there. She was also a single parent, a primary caregiver for the mother in her late 90s, and was traveling to August 17th to 22nd to move her son into college. So she says, based on all of that, she should be allowed to be a day late. That there, she should get the equitable tolling option. Now, like I said, this could be a much more compelling case if only she wasn't an attorney. That's going to be her big issue. Fundamentally, that was what I thought from day one was going to be our problem, right? Tolling requires diligent pursuit of rights plus extraordinary circumstances standing in the way. They cite the Holland case and the Menominee Indian tribe case, right? This is it. It's not an easy remedy. It is applied sparingly, and the burden is on the taxpayer to show they qualify for this, right? Remember, if they fail either prong, they're going to have, the case is going to get thrown out. She failed both. The record was silent on any steps she took to verify the deadline or to direct outside counsel. Again, she's an attorney. This is simple math. It tells you right on the notice, you have 30 days from the date of this letter. You basically just need to do that simple math. That's something that, the court felt she should have reviewed, right? Or she should have directed other counsel to have other parties review. The court says we would expect attorneys, because they know that these are deadlines, to have not only the original counsel review it, right, maybe who's filing, but it's also going to be reviewed by somebody else just to make sure you don't make mistakes like this. That was their thought. And then prong two, a garden variety miscalculation is excusable neglect. We understand you did it wrong, but that's not an extraordinary circumstance. You got to meet a much higher bar. A heavy caseload is an internal management issue. She controlled her own workload, I'll get that out right, and she had co-counsel on many of her cases. And the caregiving was shared with other family members. The college move, while emotional, was not beyond her control. Her kids going off to college. I understand that it's an emotional time, but probably doesn't excuse you dropping the ball. And no, she didn't drop the ball on her clients by this, so we kind of have that. So Judge Butch found neither prong satisfied in her decision for the commissioner. In the tax court, the Eighth Circuit affirmed reviewing de novo. The Eighth Circuit said equitable tolling in tax is a theoretical safety valve, not a practical cure for administrative oversight. So you need to verify every statutory deadline through a second professional or specialized docketing software. This is not something that should be relied upon a single mental calculation. This is also true when you're just trying to do other deadline calculations. Have something else verify it, right? Make sure that's right. Put written instructions in place identifying who calculates and who files when outside counsel is engaged and you're an attorney, right? Document every affirmative step toward the deadline. Diligence must be demonstrated, not merely asserted. Document what you did and review firm workloads. Under Boechler, an overloaded practitioner is a management failure, not an extraordinary circumstance. And that's going to apply to you as a CPA or an EA as well. I know there's a lot to do. That's not going to excuse you for making these sorts of mistakes. Okay, we did get proposed regulations issued on August the 11th in basically Reg 101-355-26 for employer contribution to Trump accounts and non-discrimination rules in that area, okay? So, employer's guide to these Trump accounts. You got an illustration on screen. We're going to talk about the Trump account contribution rules here. Remember the 2,500 annual that can go in from an employer to an employee, either the employee's own account or the employee's dependent's account. They are going to clarify common law employees only. If you're self-employed, you don't get to make these contributions. So that will mean these. It should also be right. So self-employed individuals, 2% S corp shareholders are excluded from this option. You need a written plan and you need W-2 reporting for these programs. Under 129, actually I said employer education, really it's dependent care we're basing this on. We're going to have a $7,500 no exclusion limit. We're going to have a clarification 55% average benefits test. And there's going to be some remediation provisions for testing failures. And again, we're going to talk about these, issues of you've got the different vehicles for kids. You can look at the SEP 529 account, Trump accounts, pre-tax money, Trump accounts after tax. So let's review this, okay? One Big Beautiful Bill Act added Section 530 Cap A. Trump accounts based on traditional IRAs that are for minors and made modifications to Section 128, or added 128, I should say, which is the exclusion for employer contributions to Trump accounts if you meet certain requirements. The One Big Beautiful Bill Act also raised the 129 dependent care exclusion, $7,500, $3,750 for a married couple filing separately. And 128 borrows requirements similar to 129, subsection D2, 3, 6, 7, and 8, but supplies no operational detail. So they're going to clean up the 129 rules, which will help them also explain the Trump rules. So what these regulation packs are going to add, it's going to add a series of regulations from regulation section 1.128-1 all the way through 1.129-2 and signals a coming amendment to Treasury Regulation 1.125-4 for cafeteria plans that will allow for election changes. The regulations also resolve some longstanding exclusions over the 55% average benefit test under IRC Section 129D8 for dependent care plans. Now, key IRS positions here. Employee under 128 takes its common law meaning, right? Per the nationwide mutual insurance versus Darden definition. Because 129 subsection E3 was not incorporated, self-employed individuals are intentionally excluded from the section 128 participation. They said that that's not in there. So if you're self-employed or deemed self-employed, for income tax purposes, there's no exclusion. A self-employed owner may still maintain a plan for employees, but they cannot benefit personally. Remember, that 2% as shareholder is in this mix. Employers may not restrict contributions to a single trustee, since only one trust account may exist per beneficiary. That was a bone of contention. Some people want to do that. Normally like say, well, I'd like to write a check just to Vanguard, right, for all of my Trump account contributions. And they're saying no, because Trump accounts, the beneficiary can only have a single account. You got to get it to that trustee, that account. Because the trustee restrictions would block employees whose dependents hold accounts elsewhere, or if they have two working parents, right? But after you do only one plan could work. Okay. Now let's talk about the program requirements under the 128 regs under regulations 1.128-1 and -2. Number one, the program must be a separate written plan covering eligibility classes, contributions, designation, reporting, and correction procedures. That growth period runs from the account establishment through December 31st year the beneficiary turns 17. That's when the money can go in from the employer. Exclusions are capped at $2,500 per employee for 2026 and 27, not per dependent. That was a big one, right? So if you have an employee that has 3 children, all of them with Trump accounts, that's not $7,500 that can go in there. You got to split the $2,500 and divide it among the children, the 3 children, right? If they have one child, $2,500 go in that account. If you're doing it to the employee's account because they're 17 or under, $2,500 go in their account. But you don't get $2,500 per dependent, right? That's been pretty clear from the start. They're just making it very clear in the regs. Employers may rely on written employee certification of relationship and birth date, but they have to independently verify that it's a valid account. Right? Cafeteria plan salary deductions are limited to dependents' accounts and must allow prospective election changes at least monthly. And annual contributions are reported in Form W-2 Box 12 using code TA. Excess amounts become taxable wages. Non-discrimination testing, corrections, and reliance rules. Eligibility classification must rest on objective business criteria and meets a fact circumstances set or the ratio safe harbor. People like the safe harbor, so we go that way. The safe harbor percentage starts at 90% and falls 3/4 of a point for each point of non-highly compensated employee concentration above 60%. Okay. Now, the non-highly compensated average benefits must be at least 55% of highly compensated average benefits, counting only employees with benefits above 0. Failures are corrected by including excess benefits in highly compensated employees' wages on Form W-2. That program will stay qualified for the non-highly compensated employees. And a pilot match safe harbor disregard employer matches of Section 6434 pilot contributions. $1,000 for employer for children born 2025 to 2028. And employers must give the trustee corrective notice in 21 days safe harbor. And you can rely upon the proposed rules now. If you're ready and you're ready to go and you're ready to get your Trump accounts, your employer Trump account program started, you can go with these. That's not going to be a problem. How long do you need to keep records? That was a question in the Beacom versus Commissioner case. Tax Court Remand Decision 2020-665. Decision was issued on August the 11th. And we're going to find out that burden can be perpetual. And failing to do it, in this case, cost the Beacons all of their ultimate minimum tax credits. Okay. Now, this is the carryover trap. We got an illustration here, right? Why the problem has to be here. There is the false finish line. Telling people that they need to keep the records, just for 5 years, 6 years, 7 years, ignores the fact that that's not what the rule says. What the law tells us is the IRS can only assess tax, absent fraud, for returns that were within a 3-year time period going from the due date, or 6-year time period for substantial understatement of income, gross income. Now, what it says is you have to maintain all records material to the computation of the tax for that year. That's where you get in trouble. People skip those words, right? We'll get to that. And because they skip that part of the wording, they tell people 7 years records is good enough because the problem is you got to determine what are records that are potentially relevant to that tax in this case. And in this case, here's our problem. Carryovers are a huge problem for this. And remember, NOL carryover can last now, 20 years? Actually, 20 years, I think I'd say Arizona's. It's just, federals are now basically unlimited. If I have a carryover and I've yet to exhaust the carryover from 7 years, let's say from 3 years ago, I'm going to still need those records until I get to the last return that is impacted by that carryover or could be impacted by it. And that's the problem. We have to go all the way back to the origin of the loss, which means you might need to keep records forever. Other records may be kept forever, 1031 exchange documentation, until we've gotten to the very end of the chain and cash totally out, or the person dies. I need every transaction and the records for every transaction, the full 1031 chain. I can't just have the tax returns. This, unfortunately, is a lesson that was not learned by Beacon, who misunderstood what's in IRS publication. That's going to be the problem. So the IRS in this case, it's a case of Gerald and Jean Beacon, right? They determined $11,057 deficiency and a $2,211.40 accuracy-related penalty for 2021 after disallowing an AMT credit carry forward in full. Usually the carry forwards are going to be the problem. The taxpayer relied on TurboTax to track the credit. And you do that with your own software, right? Remember, every year pro formas, and it brings the carryover number to the next return. Okay. They believe the credit started in 1999 or 2000 with incentive stock option exercise. They've been slowly being able to use it up over the years. But note, they say they believed it did. They couldn't really establish that. Now, they did have an argument for why they couldn't. The 2008 home flood destroyed all pre-2008 paper records, and the pre-2008 TurboTax data could not be retrieved. Now, the IRS had no transcripts for 2017. The only earlier evidence was unsigned 2010 and 2013 returns showing a 62,190 Form 8801 carry forward with no credit used. So we know in 2013, they supposedly had a carryover. We don't know where it came from, by the way, but we know that's there. Verified returns show the credit drawn down from 57,025 in 2017 to 30,228 carried forward after 21. So, bingo. That's what we've got. The problem is we have no evidence whatsoever of what generated the credit. Now, the unsigned 2010 and 2013 returns were exchanged late under the standing pretrial order, but they were admitted anyway because the court decided that they didn't really prove anything. Might as well have them in the record because it didn't disadvantage the IRS because the IRS is going to win this one regardless, right? They confirmed a carryover without explaining its origin. Section 7491, subsection A of the code did not shift the burden onto the IRS. The taxpayer offered no credible evidence of credit origin. They try to say, well, the burden's been shifted to the IRS. We cooperated with them. It's like, no, you've never presented credible evidence of the origin of the credit. That's yours to have to show. You've never shown that. Credits like deductions are a matter of legislative grace, and Section 6001 imposed an affirmative duty to keep adequate records. And casual loss of records is no excuse. A taxpayer who loses records through no fault of his own is still not fully relieved of it, though the courts will be more understanding. Taxpayers are expected to reconstruct records from secondary sources. They didn't do anything to reconstruct because, honestly, they believe the TurboTax carryover was good enough. It wasn't, but, that was their belief. Now, Section 53 of the Internal Revenue Code allows a minimum tax credit equal to the prior adjusted net minimum tax over credits already allowed, limited by Section 53, subsection C. Without the original return, the first claiming return, or any intervening returns, the court could not verify either that the right, the source of the credit, how do we have this credit, or how much remains. And you got to prove both before you're going to get a credit in 21. They could prove neither, right? Under Section 6214, subsection B, the court may examine prior years, but it need not accept unverified, undocumented testimony. The taxpayers misread Publication 17, Your Income Tax. Records must be kept for limitation periods of the return on which the item is used. Again, they read that as saying once you got past that period, any records from that year, you can take the boxes and shred them. Have you ever been asked, can I get rid of these boxes we're storing and shred them? How long do I have to keep the stuff? That answer is a complicated answer. Hopefully, you're not telling clients 5 years or 7 years or 10 years or any fixed number. You're going to have to say it depends. And the first thing we're going to have to look at is carryovers for every potentially open year. So that would go back 6 years, right? We have 6 years because gross understatement, we could have to be opened up and then see if there's any carryovers into that year. And then have to determine when do those carryovers originate. And I need the evidence, right? Records proving the origination number is correct on that first return. And then I've really got to be able to prove every return intervening, right? And how much it fits. I really need all the records back to the origination date. Which means I probably can't throw virtually anything away if I've got this carryover that they're not using up very quickly. Second problem, like I said, are things like 1031 exchanges, which are individual parts of the records from that year, that we need to pull out and keep because that particular item will impact things this year. And we need that. We need to show how much money we put in because that added basis then, and we got to be able to prove our basis here at the end. So we know what our adjusted basis is when we're computing our gain or loss. Right. So records had to be retained for 7 years from 2021, not 7 years from 1999 or 2000. And those records included, if 1999 or 2000 was the origination year, they need to keep that 1999 return and records because they needed that to prove the 2021 carryover. Treasury Regulation Section 1.6001-1 subsection E says you must keep records that are material to the amounts computed on the return for as long as the carryover is used. That generating documents must be kept indefinitely until we are out of that. We get to zero credit carryover. Only then can we start looking at when we can finally get rid of those 99 returns, assuming they don't matter for anything else. And that means we need to wait 7 years from 2021. Let that statute go out entirely. And then we could get rid of those 99 records, assuming there's nothing else we need to worry about from those records. This is not a simple answer, right? And your software isn't going to help you here, right? In this particular issue. So the $11,057 underpayment was substantial underpayment. That's all the service had to do to support the 20% penalty, right? So the IRS met its burden under 7491 subsection C, including they did have the proper written supervisory approval under IRC section 6751 subsection B1, which they need in this case. Reliance on TurboTax, though, was rejected. Court said tax preparation software is only good as information one puts into it. Commercial software is not a professional tax advisor, so it cannot establish reasonable cause under 6664 subsection C. Definitely an issue. Keep the original returns and forms for NOLs, AMT credits, capital loss, passive loss, the credit overs used, plus limitation periods, and the supporting documentation. Is that unfair? Might be, but you're claiming a benefit in this year, and that benefit is only right if the original credit was properly computed and it's been properly absorbed in each intervening year. And yes, the IRS can go back to those intervening years, and while normally they're not going to open an exam on each year, they could, especially if it's noted there are mistakes in the current year's return that are of a nature that make them likely to happen in earlier years. So that's it. After any casually obtained transcripts or Form 4506 copies and gather secondary evidence, you need to show the court you acted reasonably to get as much as you could. If you do that, you're likely to get the court to go along with this. If, however, you have nothing because, hey, TurboTax has a number. Yeah, it doesn't matter. TurboTax has a number. It doesn't matter if UltraTax has a number. It doesn't matter if Lacert has a number or ProFX has a number. Irrelevant. That's not going to work. Okay. Now let's go to the taxpayer that should be very grateful to Attorney Boechler. I don't know if they're going to send some money over if they actually end up winning their tax court case, but maybe. We'll have to see. This is the 8th Circuit is going to kick into the post-Boechler consensus in Maniktala versus Commissioner. This is case number 25-1366 from the 8th Circuit Court of Appeals, issued August the 11th. So, beyond the 90-day bar, per the tax court and the 8th Circuit's previous interpretation, the 90-day rule on assessments, on challenging your notice of deficiency in the tax court, was an absolute bar. And it still is in any circuit that has not yet gone along with Boechler. But we've yet to have a circuit that has heard the case post-Boechler, that has actually said it's not, that it's still a, absolute jurisdictional requirement, except the tax court keeps saying it. But the tax court basically is going to have to follow the law of the circuit to which it's appealing under the Golson rule. So we're getting more and more circuits where there at least a theoretical chance of getting, a equitable relief. This is the new, and if you look at our illustration on the screen or on the slides, you get down to the slides, essentially we're now going over to the right side of the screen, which we're going to have a more fair solution, and more circuit courts of appeals picking this up. I do wonder if the tax court will finally throw in the towel. We'll have to see, right? So this again, we're looking at the 90-day window. The fact there was no clear statement from Congress that this is jurisdictional, and the court rejected that this is absolute finality. So overturning the tax court, so now in yet another circuit, the tax court is going to have to consider equitable tolling. So in this case, the taxpayers claimed a Section 41 research credits flowing from Branch Pattern Inc., which was an S corporation. The IRS disallowed the credits and mailed a notice of deficiency to the shareholders on December 20th of 2023. That notice listed properly March 19, 2024 as the last date of file petition in the tax court. Because of unexplained transit delays, the taxpayers did not receive the notice until July 9th of 2024. 10 days after that, so moving rapidly once they finally got it, on July 19th, 2024, the court, basically filed with the tax court. And on July 19th, essentially, I should say, on July 19th, they filed. The court would dismiss for lack of jurisdiction, saying, you're late. IRS sent this notice to the last known address. That's what they have to do. That starts the 90-day clock running. We don't care what your excuse is, including the Postal Service screwed up and didn't delay it until, basically July of 24, basically essentially 7 months after the notice has been issued. That's not, that's not the IRS's problem. That's yours. So the taxpayers appealed this to the Eighth Circuit, and the sole issue before the court is the Section 6213, subsection A, 90-day deadline, a jurisdictional or claims processing rule? Jurisdictional rule, the taxpayers are out of luck. You miss that date, you're gone. There's no way in, no matter what your excuse is. If it's merely a claims processing rule, then equitable tolling should apply, and you can argue for it. Again, it won't be easy to get. Talk to the attorney Boechler about that one, but it's open for discussion. Okay. Now, the court reviewed the jurisdiction dismission on a de novo basis, and it did note that in 1977, in the case of Andrews versus Commissioner, the Eighth Circuit has declared the tax court powerless over untimely petitions. Now, the opinion notes that the panel may depart from precedent undermined by intervening Supreme Court authority, and they're going to say Boechler did this. Boechler and some other cases did it, right? Andrews contained no analysis of jurisdictional question, weakening its precedential nature. Wilkins versus United States Supreme Court decision warns that courts have misused the label jurisdictional without elaboration, and those cases should be suspect, right? Jurisdictional rules govern the court's power. Claims processing rule merely order litigation. Time bars limit a court's power only where Congress has clearly said no. A plausible, or even the fact it's a better reading to assume it's a no, is not enough. Congress has to clearly say no. That's Supreme Court standard. So now the panel turns to the actual statute here under 6213. 90-day clause speaks to what the taxpayer may do, not to the court's authority to hear the case. The only jurisdictional language in Section 6213A limits the tax court's power to enjoin action or order refunds. Congress, therefore, the court says, knew how to cabin jurisdiction, limit it, and chose to restrict only those ancillary powers. A requirement does not become jurisdictional merely because it sits near jurisdictional text. They said, as in Boechler, there was no clear tie links the deadline to the jurisdictional grant. Here, the connection is even weaker per the court than in Boechler. Now, the tax court claims just the opposite. The commissioner's section 6459 subsection D finality argument failed. A harsh result for a few taxpayers is not a clear congressional statement. Their argument is that by going here and getting a dismissal, under equitable tolling, they didn't meet the requirements. They claim that that would foreclose the taxpayer from then paying the tax and suing in district court. The court understands theoretically that problem, but the court says that's not a big enough issue to block this, right? That harsh result for a few taxpayers who try to get this, the jurisdictional claim barred, and try to get around that by arguing for equitable tolling, and then lose that argument, and that they may have no recourse now. That's just how it does. That is a risk in going forward. That's going to be their issue. So the holding. The filing deadline for this purpose under 6213 subsection A is a quintessential, I love how courts love language like that, claims processing rule. Right. So a non-jurisdictional deadline carries a rebuttable presumption of equitable tolling under Irwin. Section 6213 subsection A does not bar tolling. It's directed at the taxpayer and lacks technical detail that defeated tolling in the Brockcamp case. Dismissal was reversed, remanded so the tax court can weigh diligence in extraordinary circumstances. Now, here's the important now. The second, third, sixth, and eighth circuits now treat the deadline as non-jurisdictional. The seventh and the ninth are the other two circuits to have ruled, but these are pre-Boechler cases. They say that they say that basically it's not jurisdictional, but just like the Eighth Circuit, there's a decent chance if you take a case to those two that they will reconsider their precedent. And again, in other circuits, we don't have a ruling either way. So filing within 10 days of actual receipt does strongly support the taxpayer's diligence on remand. Now, tolling supplements but never replaces the timely mailing rules. You don't want to have to argue this. Seriously. If there is any chance of getting it within the 90th day, obviously in this case, assuming they really never got it, and they convinced the court that there's whatever explanation. There's not an explanation that would explain why it was somewhat due to their negligence. They hadn't updated the address with the IRS. They did something else different. Whatever happened, they otherwise should have been aware this was coming because of other things that had gone on. Yeah. Those are sort of things left to argue, but assuming they don't, they could get their day in court, right? But understand, if it's been blown, you have a chance. But understand, in the 7th and 9th circuits, unless those circuits are willing to override their precedent, I remember the 8th Circuit just did in this case, they're jurisdictional. And remember, in every circuit but the 2nd, 3rd, 6th, and 8th, unless the tax court reverses its position, we are going to have the tax court. If you go to tax court, you will have an initial dismissal. You're going to have to be ready to go to the Court of Appeals. Might they change their mind? They have lost in 4 circuits, not one in one yet. Is that enough to get the tax court to back down? We'll have to see. Okay. Next up, IRS Notice 2026-49 issued on August 12th. This is responding to a charge to the IRS under Secure 2.0 Act to standardize retirement plan rollovers and trustee-to-trustee transfers, right? So the IRS is basically announcing and, kind of suggesting we want to make this required, a 5-step transfer process, which we'll discuss here, for transfers from a qualified retirement plan that's eligible for rollover, right? You inherit the IRA, right? The inherited IRA comes to you, right, in all these things. And they're going to standardize the trustee-to-trustee transfer process. Remember, if it's an inherited IRA, a spouse can treat that as their own and put the money in. So a surviving spouse, we can actually take a check. However, for any other person, they can't take the check made out to them alone. It's got to be made out to the trustee, maybe to the trustee and the beneficiary. But it's got to go through the trustee-to-trustee process. It is messy. A lot of especially smaller plans have no good, or even some larger ones have really no good procedures. There's no standard procedure that works for every plan. And so Congress said, IRS, clear this up. We have standardized procedures been developed by the financial services industry for trustee-to-trustee transfers for IRAs everybody uses. We don't have that for qualified plan to IRA transfers, and that's what this is after. So key people who should listen to this are those who are involved with advising clients who have qualified retirement plans, because that's who's going to have most things to do here. So Secure 2.0 Act, as part of the Act, they directed the IRS, the Treasury in Section 324 of the Act, to essentially issue sample forms and protocols to simplify, standardize, and expedite rollovers and trustee-to-trustee transfers. Now, this notice proposes 4 sample forms and a 5-step sequential rollover procedure built around electronic plan-to-plan transfers. GAO Report 13-30 found plans lack uniform verification requirements, shifting administrative burdens onto participants, and the GAO called the mailing rollover checks for participants chaotic. In GAO Report 24-103577, it found nearly 1/3 of participants are still required to forward paper checks to the trustee on their own. The plan will not do it. And that has been criticized by the GAO as making this a much messier and more error-prone process than it needs to be. IRA to IRA transfers already move electronically through ACATS under the FINRA Rule 11870. This is the model they want to follow for plan-to-plan modernization. So here's the basic rules that we have here, statutory and regulatory. Section 401, subsection A31 requires plans, qualified plans, to honor a distributee's election for a direct trustee-to-trustee transfer to a specified eligible retirement plan. That's required so that those that inherit, right, guy dies while an employee, they've inherited the plan, they can move that to an IRA because the trustees, usually plans do not want to be handling funds that are basically employee, funds for for relatives of the deceased employee. They want to get rid of those as fast as possible. And, they want to move them away. Now, Section 402, subsection C1 excludes eligible rollover distributions from income. After-tax amounts move only by direct transfer to a plan with separate accounting or to an IRA. Right? That's going to be there. Rollovers must be completed within 60 days under 402, subsection C1. Requirement distributions, hardship distributions, and substantial payments are not eligible. Under Treasury Reg 1.41A31-1, question and answer 6A permits any reasonable election procedures but Q&A 6B bars procedures that substantially impair rights to roll over. This is the authority they're going to use to try to go under this. Impermissible examples including demanding an opinion of counsel, an automatic return letter, or an identification letter from the receiving plan. Q&A 14A protects a receiving plan that reasonably concluded a rollover was valid, and Revenue Ruling 214-9 describes 2 reliance situations that plans can use. That's where we stand. The IRS is proposing a 5-step standardized procedure. In step 1, the participant will submit a Form 1 found in the appendix to this procedure, authorizing the receiving plan to contact the distributing plan and coordinate the transfer. The receiving plan will receive a 20-digit rollover identification number. Sounds familiar from what they're doing now with the IRAs, with the Savers Match. And they send Form 2, another also in, an appendix to this, right, with the authorization. The distributing plan verifies the identity. Phishing-resistant multi-factor authentication is basically suggested, and certifies the qualifications and the amounts on Form 3. Step 4, the receiving plan returns Form 4, accepting the rollover and specifying the ACH coordinates or the clearinghouse to be used. And distributing plan transfers the assets electronically. The participant never touches the funds. The procedure applies where at least one plan is an employer plan and no more than one is an IRA. Pure IRA to IRA transfers stay with the ACAT system. Okay. Now, security, the rollover identification number limits the transmission of participants' personally identifiable information. Encryption at rest and in transit aligns with Department of Labor cybersecurity guidance on plans. Plans are encouraged to build forms into an API or clearinghouse consistent with Executive Order 14247 on electronic payments. A fallback allows a paper check payable to the receiving plan for the benefit of the participant with the RIN, that number, on the memo line mailed to the plan. Okay. Used as optional, no safe harbors are provided. Comments are due on or before October 23rd of 2026. Future guidance may remove Q&A 4 and Revenue Ruling 2014-9 Situation 2 to mandate electronic or direct-to-plan transfers and add form-based safe harbors. Medallion signature guarantees and blocking electronic transfers may be declared in this guidance impermissible procedures with a transition window to get your systems together. So if you're dealing with a plan that currently is just giving checks to participants, which, as Geo discovered, apparently 1/3 of participants, that's how it's being handled, they need to start getting ready for the electronic future. Because remember, Congress says fix this to the IRS. A $70 million theft is what we're going to talk about next here. Or a fraud. This is a $70 million Dubai fraud. This is a theft loss deduction case in the case of Deutsch versus Commissioner. Tax Memorandum Decision 2026-66. Decision came down on August the 12th of 2026. With our illustration here, if you have it on screen, you're going to see we outline the anatomy of a deductible theft, defining what's a theft under the relevant law. This case turned to be Texas law. That'll be a slightly different analysis if you're not under Texas law, which most cases won't be. We have the court found 3 acts of deception that pulled it into the Texas law definition. And then we have the tax court ruling and the financial breakdown of what did and didn't count for this purpose. And it resulted in a $925,000 deduction to the taxpayer. So let's talk about the Deutsch case. Texas businessman was pitched a $70 million Dubai group investment to develop a Mexican ranch. Okay. He advanced $175,000 under a notarized note secured by Mexican real estate the promoter had already deeded to his son. Okay. So that's no problem. 200,000 wires in October 2009, a 350,000 good faith wire followed, chasing a check supposedly misprinted as Paul S. Bissell. That's somebody else involved in this, right? That became part of the story. Okay. He also advanced $295,600 over 19 months. 53 wire transfers plus Western Union for the promoter's hotels, airfare, and living costs. This is good old Paul, right? The investigators found that Paul Davidson, another party in this, was fictitious. A September 2010 property settlement proved worthless and the promoter vanished. Voila, we're holding the bag and we've written a bunch of checks. So let's talk about the Section 195 framework and what's a theft under Texas law. 2010 tax return claimed a $1,552,007 theft loss. The IRS disallowed entirely, asserting a $107,913 deficiency and a $21,583 penalty. Under IRC Section 165, subsection C2, allows losses from transactions entered into for profit. Treasury Reg 1.165-8, subsection A2, sets the loss in the year of discovery. No portion is sustained while a claim for reimbursement carries a reasonable prospect of recovery. A question of foresight, not hindsight. The tax court wants to emphasize, we're not going to look back and say, hey, look, the money showed up. If in fact, at the end of the year, there appeared no reasonable prospect of recovery, then it's deductible that year. The fact that later they might discover a way it could be recovered is a different issue, right? But they had to reasonably not believe that existed at the time. Whether a theft occurred will turn on state or relevant law. And we had a case a little while back where I think we talked about Turks and Caicos law. Fine. Okay, same issue here, but generally it's going to be U.S. state law. Texas, Section 3103, subsection A, requires unlawful appropriation with intent to deprive or consent induced by deception. The taxpayer has a preponderance of the evidence requirement. No criminal conviction or prosecution of the perpetrator is required to claim a theft loss. It's kind of helpful, but that'll help prove your case. Guys convicted of a theft under Texas law, that would help you, but it's not fatal to your case because, again, people like this disappear. So it's there. Now, what the court allowed, they allowed wire transfers, but they didn't allow some expenses. So we'll talk about that. The court allowed 925 of direct wire transfers as a theft loss under Texas law. Their deceptive was objective. Collateral was already transferred to the son when supposedly it was pledged against this note. A false claim of signature authority was put in place while all that money is going over, and as was this fictitious Paul Davidson, who was basically explaining and giving a series of lies to entice him to transfer these funds, right? The taxpayer doesn't need to figure out who Paul Davidson was, right? The law secured the ends of whoever orchestrated the scheme. Now, it might have been the guy he talked to. That may have been, Paul Davidson may not exist at all. We don't know. It might be just the name that was used by the promoter. The promoter could be behind this whole thing, but we can't prove that. The promoter could, and the court pointed this out, conceivably could have been just as duped as this guy was. And he just wouldn't want a judgment against him now, so he's trying to disappear because he was kind of negligent in promoting it, at least, even if he wasn't aware of the deception. But the court did not allow the deduction for $295,600 advanced living expenses because, remember, those are for the promoter, and the promoter himself may have been defrauded. We don't know. We don't have evidence whether he was in on the scam or not. I'm sure the taxpayer believes he was. But your belief he was is not proof he was. You've got to have preponderance of evidence to show he was. Each category of funds must be substantiated separately. A general fraud in the scheme does not convert everything into the theft loss. And these are considered ancillary advances that weren't directly part of the fraud. Unless you collect Paul Vizel, that he was making false statements that he knew was false. And we just can't do that. The prospects of recovery died in late 2010. The settlement deadline was breached, the deeds were worthless, and counsel called litigation futile. That standard is objective and does not demand what the court called incorrigible optimism. So a later demand email list that they sent on just a flyer does not postpone the loss. The court reopened the record to admit the civil penalty approval form, finding that, yes, the IRS had approved the penalty. Taxpayers still got out of the penalty the reasonable reliance on their CPA, who advised them under 6064. They asked for advice if this was deductible. They gave them all the records, all information. They got out of the penalty. Again, you can do that. The CPA was wrong about the $295, but merely the fact his advice was wrong doesn't mean it wasn't reasonable to rely on it. Okay. Now, some practice points. Remember, for the clients, you need to substantiate each transfer separately. Make sure you document specifically about why there's no reasonable chance of recovery. It's really good to have the attorney, issue a letter stating, listen, litigating this, we can't even find the guy to litigate. Prospects of getting any money back through litigation are, basically negligent. They're gone. We don't have, in this case, anybody to sue, or the parties we might be able to sue, our case is super weak against. So I don't see any realistic point of, paying me to try to find other ways to get the money at this point. I don't see any reasonable chance they're going to succeed, right? And keep contemporaneous records of what you told the CPA, right? Or the tax advisor. It's important to document that advice was requested, document the data that was given to the advisor, and document the advice the advisor gave you. We are going to be wrong in our advice every so often. That's simply the way the world works. There is a world in which a different judge hears this case and concludes that to that judge, he thinks Paul S. Vizel, whoever he may be, was actually in on it. So the living expenses for him would have been part of the fraud. You could be wrong on that. It's a judgment call. It's going to be the judge that's going to decide it. That doesn't mean, though, that it was unreasonable for the taxpayers to rely on your advice. Okay. And like I said, we still have to have the position. We have to meet those requirements. But, he advised to do that, and he didn't advise them it need to be disclosed. That'd be there. Now, one I'm going to probably go through very quickly here, because this is definitely not my area of tax law. We have proposed regulations for foreign currency gain or loss of controlled foreign corporations. Proposed reg here is Reg 103-844-26, proposed on August the 14th. Right. So we're going to streamline Section 987 compliance, that's on foreign currency gains or losses, for controlled foreign corporations with an exemption election. You'll see that's outlined for you on the diagram. You can go through that at your leisure, right, to look at it. Now, his proposed regulations create an elective CFC exemption for control for corporations in Section 987(3), subsection 3. Every so often, Congress does that. Instead of using A, B, C, they use 1, 2, 3, etc. So 97, subsection 3, remittance regime for qualified business units with a non-dollar functional currency. Under Section 987, subsection 3, otherwise require proper adjustments on transfers between qualified business units and recognition of currency gain or loss on that remittance. The authority rests on Section 987, subsection 3, Section 99, subsection C, and Section 7805, subsection A. The IRS reads these as permitting them to propose controlled foreign corporations specific elective rules. 2024 final regulations force current controlled foreign corporations to track qualified business units and compute net unrecognized gain on a balance sheet basis, a burden taxpayers frequently criticized under those regs. Because a controlled foreign corporation computes earnings in its functional currency under Section 985, subsection B, its income is not measured by accession to wealth in dollars. Deferred currency movement is still captured later through other provisions. For example, Section 1001 on the sale of the controlled foreign corporation stock. So it's not as if it would go totally untaxed if you make this election. Now, the mechanics of this election, proposed Section 1987-15, subsection B1, Section 987, subsection C will not apply to an exempt controlled foreign corporation. The Section 987 regulations apply only as provided in Sections 1.197, 15, and 16, added by this reg. Income determination under Section 197, subsection 1 and subsection 2 will still apply. The qualified business unit's taxable income and earnings must still be computed and translated. Regulations are applied as if a current rate election were in effect, so historic exchange rates need not be tracked. Qualified business unit income is translated at the yearly average rate. Transfer between the qualified business unit and the owner uses the spot rate on the transfer date. An exempt controlled foreign corporation recognizes no Section 987 gain or loss on termination of qualified business unit under Section 1.1987-8, subsection E. Most Section 1.987-9B record keeping requirements are switched off. Only records substantiating pre-election amounts and inbound transactions are needed. Right. Now, consistency rules stop taxpayers from electing only for built-in gains while keeping recognitions for built-in loss. Anti-abuse is in here. All domestic corporations that are affiliates under Section 1, under Section regulations say 1.901I-1 subsection B on the last day of the year are treated as a single United States person. Consolidated groups and commonly controlled domestic corporations must elect consistently for all majority-owned controlled foreign corporations. Domestic partnerships are treated like foreign partnerships for indirect ownership under Section 958, subsection A, and a controlled group election with the principal purpose of triggering demean revocation is disregarded. The election remains intact. You can't get rid of it that way. And a transaction with the principal purpose of avoiding consistency caused the election to be deemed made for the affected controlled foreign corporations. Okay. Now, transition rules and the $50 million exception. Electing taxpayers must compute Section 97 gain or loss, recognize it ratably over 120-month amortization period, so 10 years, basically. Treasury rejected a fresh start elimination of built-in pools, citing whipsaw risk, selective gain eliminations, and loss amortization. A qualified business unit with average assets over $50 million for the 3 preceding years is deemed to have zero pre-election gain or loss. So again, below that level, zero. We're done with this. All qualifying business units of an exempt controlled corporation in the same country are aggregated for the threshold, and values come from U.S. GAAP balance sheets on Form 8858, Schedule F. Whereas estimates the threshold exempts about 75% of Section 97 qualified business units, while excluding under 5% of reported qualifying business units assets. In essence, the money's concentrated, right, in the top 25%, the largest 25%. And Regulation 1.97-10, subsection E5II is amended to recognize pre-transition amounts over 120 months rather than 10 taxable years, curing any short year distortion. Inbound transactions, partnerships, and reliance are covered on this final slide. Proposed Section 1.987-16 prevents importation of excess asset basis when a domestic corporation acquires an exempt controlled foreign corporation's assets in a Section 332 liquidation or 368 reorganization. The transferor recognized 97 gain equal to its Section 97 asset basis immediately before and not as a part of the non-recognition transaction. Right. Asset basis may be computed in our 72-month look-back methodology or the regulation Section 1.367B-3, subsection G2I excess basis method. A $25 million de minimis exception applies. Losses are never recognized in inbound transactions, consistent with regulation section 1.367B-3, and to prevent loss triggering transactions. A partnership with at least 80% owned by exempt controlled foreign corporations in the same group is an exempt partnership. Partners take their share of pre-election amounts, over 120 months. And taxpayer may rely on these proposed rules for years beginning after December 31st, 2024, if applied consistently. The 25 and 27 elections are due by October 15th of 2027. Okay, now for the big change of direction. The Fifth Circuit imposes now a substantive management test, substantive management test for limited partners self-employment tax exception. We are going to radically change the Fifth Circuit Serious Solutions opinion, and we're going to change the name of it because the partnership changed the name at the interim. So our new case is K. Elaine LLLP versus Commissioner, case number 2460240 from the Fifth Circuit on August the 12th, withdrawing their opinion issued in Serious Solution LLP, the former name of this partnership, versus Commissioner. That was found at 165 F4 374. That was issued in 2026 as well. So they changed their mind. So we're going to talk about this. The January decision used a simple, are they a limited partner under state law? 2026, now the current view in the Fifth Circuit is we're going to ignore the state law label, which remember is kind of what Serious Solutions was asking them to pay attention to, and instead determine if you have a significant role in managing or running the business. The same judge dissented. This is a 2-1 decision by the panel. And the judges, the center is still not really very much, enamored with this decision. He respects the fact that they corrected some what he thought was obvious errors in ignoring parts of definitions they cited in the first decision that was supposed to see what did limited partner mean in 1977. But he then criticized them for essentially inventing a rule out of thin air. In his view, in essence, all they did was put a different rule in for the IRS's rule with no real explanation that ties it better to the law than what the IRS did. And so he's saying, in essence, there's no point. The other real problem from a practical standpoint is I don't know that the partners in the partnership are going to be any happier with this than the dissenting judges. Because I think they went from a sure win, right? They weren't going to pay tax on self-employment income to now it's going to be, at least for some of the partners, if not all of them, a very difficult way to show they're not involved in a more than minimal way in running the business. Because in many ways, they are the business. That was kind of the problem. Okay, so let's go back to the beginning of this whole case. Serious Solutions, which is now K. Elaine, was a Delaware limited liability partnership operating a Houston-based consulting firm who was taxed as a partnership. For 2014 to 2016, the entity was owned by the individual partners plus a corporate general partner held under 1%. The partners worked exclusively and full-time for the firm. They delivered client engagements, developed business supervised people that worked there, and hired staff. That sounds like a bad set of facts if we're going to worry about are they running the business. But we'll leave it there. All ordinary income was allocated to the individuals who excluded from self-employment income under Section 1402A13 limited partner exception because they were a limited partnership. The IRS issued final partnership administrative adjustments, raising net earnings self-employment from $0 to roughly $5.9 million and $7.9 million in the 2014 and 2015 years in question. Okay. Now, as that case was moving forward in the tax court, in Sorbonne Capital Partners issued in 2023, the tax court held limited partners means passive investors requiring a functional analysis. Because they said the law says limited partners as such, and they said as such means we need to do a functional analysis to see if these people are really passive investors. Now, the parties stipulated serious partners failed that functional test. The tax court therefore entered a decision against the taxpayers under Rule 251, which enabled the appeal. The Fifth Circuit is traditionally considered the most taxpayer-friendly circuit you can take your case to. I have no doubt there are a number of parties very interested in this whole, can we form a limited partnership, get out of this, especially in the hedge funds and investment management area. They wanted the first decision to be one they expected to come back and say, we're going to use the limited partner rule. And they thought the Fifth Circuit was the best chance to get that decision. And to be honest, we've seen oral arguments in other circuits that have held their arguments on this at this point. That part sounded right? I think they had the best chance catching on here. Now, the parties stipulated, of course, they followed that, so they're there. So this got them to the Fifth Circuit, to this panel. January 16th of this year, which we talked about, they rejected Sorbonne to find limited partners solely by state law limited liability. If you're a limited partner under state law, you meet 1402A13. They dodge dealing with, if you're not that, does that mean you have to pay self-employment tax? And by the way, that's not a minor decision because LLC members are not limited partners under any state law. LLCs are a whole different kettle of fish. It's like calling a shareholder a limited partner. They're not. They might have limited liability, but it's not a limited partnership statute that they do. Therein comes our problem. On August the 12th, the court denied an en banc review, granted a panel rehearing, withdrew the opinion, and issued the substitute opinion. That's an interesting set of steps. And you always wonder why. And normally I believe that it had been telegraphed to the panel that you need to have a rehearing and you need to, consider these changes, or we probably are going to argue for en banc and essentially overrule you. So essentially, you can come back with a different decision, right, that meets our criteria, and we'll be okay with that. So what they did is they abandoned the limited liability test. And I don't have doubt that more than a few other judges on the court got very worried about what this means for LLCs. Because they kind of dodged that whole thing, because this would overturn Rankmeyer, but suggests you have to be a limited partner. And again, LLC members are not limited partners, right? In favor of what's now a management-based standard. I also think LLCs may have been consideration because management-based standard seems like it's almost perfectly drawn up to say managers in an LLC, including member managers of an LLC, are basically not limited partners, but mere members of the LLC are limited partners. Okay, because limited partners is undefined in the code, the court looked to its ordinary meaning when the exception was enacted in 1977. This is identical to what the tax court said they did, right? Sources included period legal dictionaries, the 1916 Uniform Limited Partnership Act, and the 1976, revised Uniform Limited Partnership Act control rules, Crane and Bromberg on partnership, and 1950s case law. Holding a limited partner is a partner who plays no significant role in managing or running a business, is what they concluded from that. Now, remember, the tax court said, in essence, you had no you had no significant participation. That definition is different, but the question now becomes, how different is this definition? Right? Now, the court criticized Sorbonne as a rule divorced from the text that would bar even minor involvement in partnership affairs. They claim They're just opening a door for minor involvement. But I don't really read Soroban as banning that. I mean, I think their criticism in the first decision that Soroban's not clear, there's not a clearly defined test, means that it's not clear that minor would have been enough to get you in. And now we still got to figure out, well, what's no significant role? So what exactly is that minor involvement? And how high can you go before your involvement ceases to be minor? Right? Because the tax board applied the passive investor standard instead, decision was vacated and remanded. I'll give you a little guess right now of how that decision is going to come back, assuming it goes to trial. Tax court is going to say, yep, okay, ignore passive, but every one of you guys played a significant role in managing or running a business, period. We're done. And I will be really shocked if the tax court does not come back with that and basically bounces it back and dares the partnership and dares the Fifth Circuit to now have to write a real rule. Right? Explain why it doesn't qualify. Because they really did. They didn't really explain anything here. What about the dissent? Judge Graves again dissented, same as last time, arguing the manual distinction has no basis in the text of the law. The same thing the panel claimed the IRS's view had. And misreads Pastille Products, which was a case they tried to use to back up this type of view. He warned the standard potentially creates a loophole, letting millions of dollars of earnings of self-employment tax escape tax. That is, if you mean it to be read very narrowly and you're going to have to meet a really, really high bar, that's what people are going to try to argue you mean, and that's certainly what these parties are going to argue when it goes back to the tax court. But as I've said in response to this on various forums, somebody's got to be managing this thing. And those 6 are the only people, whether acting through the corporation or acting through the partnership, that are doing any of this. I can't see how it's minor. And remember, the partnership, the corporation really is getting no allocation. The managing entity, the corporation, it's like, so realistically, it's not there. Now, so it is right. In the Fifth Circuit, Texas, Louisiana, Mississippi, technically Soroban's passive investor guess is no longer the governing law, but you got to tell me what this thing means, because I really don't have a good clue. That doesn't sound a lot like basically the passive investor rule. Now, service providing partners, though, per this panel, may so exclude distributed shares that are due to strictly non-managerial. What in the world does that mean? So, if you're going to try to thread this needle, which I don't think we yet know how to thread, you want to draft defensively, vest management, general partner, or management committee, and document the non-managerial scope of partners' duties. In essence, keep them from managing. I don't know that this agreement fits that, but again, we just don't know how the rule works. In any event, radical change in the Serious Solutions decision. So, and we don't call it Serious Solutions anymore either. So, just realize this changed things rather dramatically. We have the Evans decision next, which is a 11th Circuit case. Cases number 24-11882 and 24-11884 from the 11th Circuit this week. This is looking at highest and best use. And interestingly enough, this is a case where the tax court, where the plaintiffs, in the case where, the people who are suing the IRS, trying to get relief, they're actually the trial court, in essence, the appeals court is going to overturn the tax court on rejecting the valuation. Now, again, this does not mean they're going to win. But it does mean that, the appeals court is not just going to rubber stamp the tax court decision. They believe they skipped an analysis they needed to make. So this is Evans versus Commissioners, actually 2 cases, but we're going to use Evans. That's the lead. Again, that came out. In this case, Carter, in this case, the other plaintiff, bought 5.245 acres in Glynn County, Georgia in 2025. And 2005, after a 100-acre gift, the tract stood at 5,145 continuous acres. A 2008 rezoning allowed up to 1.16 million square feet of commercial development. In 2009, Evans paid $29,428,027 for 50% interest. That implied the whole property value is near $59 million. Right away, this looks different than our standard case. I'll tell you that right now. This was not a virtually worthless piece of property. Evans paid nearly $30 million for this thing. That makes this an unusual facts case to get started in these conservation easement cases. A 500-acre easement was granted North American Land Trust in December of 2011. The appraisal set the before value at $48,270,047 and the after value at $34,467,047. That is a just over $14 million deduction split equally between the partners. Again, unlike the cases that we've seen all the time, in this case, they are not claiming huge appreciation in this land, right? And, this background, they're not claiming huge appreciation in this land. They're also not doing a couple of other things. I think that's why the court's a little more concerned about this. So IRC section 170 subsection F3B III and section 170 subsection H allow a deduction for a qualified conservation easement protected in perpetuity. Absent comparable easement sales, Treasury section, there's a reg section 1.170 cap A-14 subsection H3 requires before and after method using highest and best use. Before value must objectively assess how intermediate or remote development is, accounting for existing zoning and restrictions. Taxpayers' experts claimed $46.3 million before and a flat 30% reduction reaching $10.3 million easement value. The IRS appraiser used 5 comparable timber sales at roughly $1,000 per acre, finding the property at $15 million, $435, and the easement at $1 million. Notice the IRS appraiser is suggesting this thing's worth substantially less than Evans paid for. Remember, Evans is not getting enough of a deduction to pay for that shortfall. The tax benefits aren't really going to get there. Now, the tax court found the taxpayers' experts could not explain the 30% reduction. Right? They just kind of felt like it's the right thing, right? Rendering their report unreliable and credit the IRS appraiser for giving the reasons why he computed, how much of a reduction would be. They're having valid arguments, not just, hey, we kind of added these two. The majority held that choosing between two facially plausible experts can virtually never be clear error. Right? It also held that because both sides agreed the use was to hold for development, no formal highest and best use analysis was required. Right? Now, Judge Branch dissents, right, in this case, right? Disagreeing on the time of development, which takes and legally decides it. She found no authority for adopting an expert's highest and best use findings and would have vacated and remanded in this case, right? So we got it. Tappy had a little different case. So the $14.175 million claim deduction was reduced to $1 million, despite favorable zoning's arm's length sale. Percentage reductions must be derived from sound discernible methodology and summing. By the way, I gave the wrong answer here. This case actually, forgot how this one runs out. Yeah, the majority did go along with the tax court. The dissent, I've got too many cases this week. The dissent said, nope, you're wrong. Again, similar to the last case, two says this, one says, you crazy. Right. So despite favorable zoning and arm's length sale, $29.4 million. Right. Percentage reductions must be derived from sound discernible methodology, summing unrelated percentages, which is what they really did, destroyed their credibility. Appraisals must document objectively how immediate remote development is, not merely development is the ultimate use. An appellate review of expert credibility is clearly erroneous. So the record must be built at the tax court level. White House Hotel remains the cautionary precedent. An opinion silent on the highest and best use invites remand, or as here, a sustained evaluation. So we have to kind of go down this, right? So again, this is our update for this week of August 17th. We had a lot of detail here. We've been going on for not quite 2 hours, but really close. You can email me at eds@currentfortaxdevelopments.com. I also will be on the Connect sites for Arizona, New Jersey, Idaho, Illinois, Minnesota, and Washington. If you have questions, you post to those sites. I see your question. I may give a response. Otherwise, we will see you back here next week for more information on current federal tax developments.